Welcome back my friends. So I'm back with another option video, this time around part 2 on the rules of options view strategy that I adhere to. Now before I begin, I just want to highlight, if you are new to option selling or the view strategy, I strongly recommend you to check out my first video on this, where I talk about the basis of option selling and the view strategy. I'll put the link in my description or my comments below. So if you're new, highly recommend you to check it out first so you understand what I'm talking about. If not, you'll be very confused and don't know what is this entire slides and sharing about. So let's start. Okay, so there are 3 rules that I adhere to for option selling. Okay, they are important for risk management and making sure that I consistently make money. Now, number 1, only view stocks you want to own. Number 2, don't be greedy with strike price. Number 3, know when not to view. So don't worry, as we go along, I'll highlight some examples and my own thoughts so you can follow better. Okay, so number 1, only view stocks you want to own. So understand that, okay, just a quick recap, when you sell cash cover put or cash secure put so called, it means you are writing a contract. That means you are agreeing to buy a stock at a certain price. So remember, no matter what strike price you set, eventually you will get assignment. There will be one day you will get it. So you must ask yourself, am I happy owning this particular stock for years? If not, you should not view this stock. Okay, you should not sell any cash cover put on this particular stock. So the stocks you view should be strong, should have strong fundamentals, businesses which are profitable. Because if you are assigned, you will be holding them for a longer term till it recovers. So I give you an example. So we have example, let's just say Microsoft or even SPY 500, okay, ETF. Let's just take an example, the current price is about $300. So you sold cash cover puts and you get assignment at $280. The price crashed to $200. So even if assigned, you can hold that and be confident they will likely recover in the long run. Example, this year, last year, okay, 2025, there's this tariff war, stock market crashed about 20-30%. But if you have held on to all these stocks, no problem, eventually they still recover back to their all-time high. Now, if you pick some stock that you don't really want to own, like maybe some random companies that has good premiums, then when you get assigned the stock price never recover, that's it, you will be at the loss. Now, number 2 is don't be greedy with your strike price. Okay, you set a lower strike price if needed, even if premiums are lesser. So sometimes, right, you set example, the stock price is now at $100. Don't have to set like $95 or $98, so close to $100. You can try to set a strike price further like $80, $85 to be safer. So one trick is you can use delta as a guide on strike price. So the classical so-called well-researched, well-documented delta to follow is usually 0.3. But there's no harm going down to 0.2 to 0.1 if you want a safer delta range. Now, what is delta in case you don't know? It tells you 2 key things. How much the option price move if the stock move $1. Now, the second thing is it roughly give you an indicator on the rough probability of getting assigned a stock. So example, 0.3 delta can be somewhere about 30% chance you will get assigned, whereby 0.2 delta is about 20% chance. So this is not exact, but it is a rough gauge there. Okay, let's just use some example, okay, when you're selling cash cover puts. So a greedy example on the left, okay, Apple is $100. You sell cash cover put at $95, which is 0.45 delta, so very close to the market price now. Now the premiums they collect is more, maybe $3. Now if the stock price Apple drops to $80, you'll be assigned at $95. Remember, selling cash cover put is always like a contract, an agreement. You agreed to buy that stock at $95. Even if Apple dropped to $1, you still have to pay $95 to buy it. Okay, that's what we talk about options. It's like a contract. So let's say, okay, you are assigned $95. You are already down $15 immediately because the current Apple share is only $80. Now, if you calculate the premiums you receive, 15 minus 3 is $12. So that's your loss. So you can see even your premiums cannot cover the loss because the share price dropped. Now a disciplined example will be this on the right. Example, Apple at $100, you sell cash cover put at $78. So it's quite far from the market price. So your strike price $78, 0.2 delta only. Of course, the premiums you collected is lesser, maybe just $1. Now the stock dropped to $80. Option will still expire worthless because it is higher than your strike price. Therefore, you will still collect $1 premium as your profit. Remember, like we said in our first video, options is dealt in 100 shares. So $1 times 100, you will get $100 profit. So you can see here, the point here is that don't be greedy. Pick a delta or a strike price which is comfortable even if the premiums are lesser. Remember, people chase higher premium and say, the risk reward isn't worth it at lower delta, so and so forth, right? That kind of thinking will destroy your account. Okay, remember, wheel strategy works by consistency. So the whole idea is you don't try to be greedy, ensure survival because that's more important than your premiums. And as long as you survive, you keep rolling and rolling, your premiums will add up slowly, slow and steady. Okay, number 3, the last and final rule that I always adhere is know when not to wheel. So meaning know when not to sell options, not to sell covered call or cash cover. So try to avoid earnings seasons, at least for me, because that's where a lot of volatility, people are predicting whether the company will do well, announce good results or not. So that's where the price of option will fluctuate a lot, especially the premiums. Avoid those hype and meme stocks like GameStop. Back then it was 200, 300. So clearly this kind of stocks has a lot of premiums, high IV, but I recommend not to touch it, at least for me. Now, be careful of high IV. They are actually a warning label, not a gift. Now, in case you don't know what is IV, let's just recap. Okay, IV just means implied volatility. So it's like the market expectation of how much the stock price will move up and down, as well as it influence the premiums. So example, a high IV will have a lot of movement, in the prices, stock prices. And because there's higher IV, more extreme swing in the stock share prices, you are more likely to get assigned. And of course, the positive side is high IV will give you more premium. Because when prices are swinging wildly, you are taking on more risk. So naturally, you get more premiums. But remember, don't be greedy. It is an indicator to tell you that it is of higher risk. Okay, just give you a quick example. Let's say it's earnings season. Apple earnings season. You sell cash cover put. Apple at $100. That's the stock price. You sell cash cover put for this Apple at $90 for 1 month duration. The IV now is at 70%. Wow, very high. Okay, let's just say the premium is $10. So that's insane. Okay, a premium of $10 is like almost 10%. So if you successfully sold this and you unassigned, you will get $10 times 100, that's $1,000. Okay, so let's say earnings season is in 1 week's time, then Apple announced their result. Earnings miss, gone case. Okay, all the analysts were expecting Apple to make like $1 trillion, but end up they report they make $1 million only. So when the market opens, Apple will crash. So let's just say Apple crashed from $100 to $70 following the poor results. Now, if you're assigned at $90 because you sold cash cover put at $90, you immediately lost $20 because now it's trading at $70, you bought it at $90. So like I said, $20 minus your $10 premium, you still lose $10. So remember, even if the IV is high, the premiums are high, it might not be enough to cover your stock loss, because of the sharp drop in price. So always bottom line is don't be greedy, especially be careful of high IV. Okay, so closing thoughts. I just want to share with you all that option selling and this wheel strategy in particular is really about risk management, staying very disciplined, and you survive long enough for probabilities to work in your favor. Like we talked about earlier, delta, right? 0.3 delta is like 30% chance of assignment, 0.2 delta, 20% chance of assignment. So you can see the odds actually kind of in your favor, especially in the long run. So to emphasize also, this view strategy option selling is actually a boring system, but pay well over time. Okay, exciting strategy like 0 days to expiry, 0 DTE, all those leverage here and there, right? Excitement usually means risk is too high. Okay, so that's the trick. And remember, most people don't fail the wheel, okay, not because they don't understand it, not because of that, okay, they understand the system, okay, it takes some time to read up and understand this view. They fail because they get greedy. Example, they start to chase for high premiums, high IV, example what Tesla, that kind, or GameStop, that kind, and they start selling very greedy strike prices. Example, Tesla 300, they maybe sell at $290, so they can collect thousands of dollars of premiums. But all it takes is for Tesla to crash from 300 to 150, right? It will blow your account out if you are not careful. Okay, so that's all. Okay, I want to keep this video short as I always do, so I won't speak further. If you have any questions, feel free to put it in the comments. I try my best to answer them.